Good morning, everybody. It is Friday, May 9th, and we are going to get started on our prep today for the equity indices, crude, and gold. First, before we do get started, just a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. Now, we'll start today by going over our positioning, and then we will take a look at the actual levels that we want to pay attention to. We mentioned this earlier, and we'll get new data at the end of the day today, but commercials did go net long in the beginning of April, and now they've been selling. And you can see that by the downside of their position and the red going down here. They've been selling. So we want to look at who are they selling to. And when we look at our systematic and algorithmic based strategies, we've mentioned this before that they were not likely. We would see we had a couple days of strong buys, and we look at this forecasting in advance. But this is going to be very similar to what we had in 2022. That's why we're still looking at this with caution, this rally. And the upside move, if we look at our systematics and algorithmic based strategies, half of their portfolio that they're going to have invested after today is coming in today. So if we look at they're buying 25 billion today, which will put them at 54 billion, which means that they're only at 29 billion right now, which would be about 11% of their total portfolio. All capital they have is going to be 90% of that is on the sidelines. They're going to buy about 10% of that today. And then if you look at the bottom right here, it kind of runs out. And we won't see them come back into the market with a large bid in any sizable manner until July. So when we think of where we are in that COT data, we have a day for good distribution today, and then we're going to run out of a buyer. So then we would look towards other strategies. We'd look for actively managed hedge funds and mutual funds, CTAs. When we look there, at least on the active fund side, not on the CTA side, we are pretty much we've gone almost full cycle. So we went from 30% invested at the beginning of April on that liquidation back to 80% now. So that's a very large shift. And we don't really ever see it get down towards zero. It'll usually bottom around that 10 to 20 percentile, but 30% gets us close to where, okay, there's no more sellers left. That's what we think when we come down here. Who's left to sell? If we can identify where the capital is in the market, then we know where the risks lie. Now we're getting to where this is all performance chasing that they will put out on a prospectus that they were invested into certain companies and partaking in the rally. But as we saw what happened back in December and February, they were fully invested, 100% invested. So we asked the same question, who's left to buy? If there's no money left, if there's no money left on the sidelines, where is the likely trade? And it's usually downside. So FOMC day went down. We knew that a week before that, fund managers had basically no capital left. So it was good distribution by the market makers. And we watched this push and pull game going on all the time. And we did the same thing into February. That's where the risks lied. And then when we broke our line in the sand, that was the key that we were going to make a bear market move. Now we are right at our line in the sand this morning on the ES, but we'll get into that when we look at levels. Um, Other positioning here. So when we start with high yield and spreads and credit risk, we mentioned that we started to get our cross, which we saw back in 2022, which was the bear market, kind of signals for further downside. We're seeing a separation there. So it's mitigating a lot of recessionary risks and saying that we won't have a recession with the tariffs. It doesn't mean that we won't have stagflation, which is our most likely outcome at the moment. But it is saying we won't have a recession. On to bond volatility. Again, coming down as all volatility has been coming down from the April move, but we are coming into an area where we've consistently seen volatility pick back up, where it gets too complacent and we see prices start to separate a little bit more in terms of spreads and bid ask, and that volatility begins rising. So range expansion. That's what we want to pay attention to today. and in the coming weeks, as the move index doesn't move as much as like the Nasdaq volatility would on a daily basis. But this is just something we want to pay attention to. So now on to multi-asset volatility. We are again coming down. So we saw the spike in the OVX when it came to 55.13. Now that's been coming down as we see uh, a rise in oil volatility ahead of that 55 level, or a rise in oil prices, declining that volatility ahead of that key 55 level. When we look at the Vixen and the VIX, they are still both elevated. So that tells us that we still have risk in the market. So we look at what's happening in terms of positioning, put that into context with what's happening in volatility, and that helps us to understand what the moves are. Everybody wants to know why things are going to happen or why they did happen. We care about when and where the money is because those are things that narratives can't change. If we know that funds are fully invested or fully on the sidelines, we know that no matter what news cycle comes out or what the comments are, what the likely direction is, because if there's nobody left to sell, you're going to go up. If there's nobody left to buy, you're going to see a liquidation. That's what we look for in when we're monitoring our data continually. So we also look at our risks as we go into catalysts. And today we have a lot of speakers on the Fed speaker side. We have the White House at 1 o'clock, and then we also have Trump at 4 o'clock. And so we want to pay attention to, as we've mentioned before, where we've seen the washing machine come back. We mentioned that. So where's the risk intraday? And today we don't have insurance for today. We don't have anybody buying protection. So we are going into this with a potential for downside if something gets said about rates, about not cutting rates that could shake up the market. So what we would watch for, and our students have access to this tool that updates intraday minute by minute, but we'll watch for when, if does that come in. If it does, then it helps to tell us when the downside is done. So yesterday we saw this, Wednesday we saw this, where it all the protection was bought in the first half hour to 40 minutes of the day. So then we could start looking for long signals. As once we got into the red zone, that tells us that too many, it's we're going to stop that downside. Too many people are getting crowded on one side, and so then we look for the opposing, and that can help you really time the market and know what is going to happen, or more specifically, when it is likely to happen, especially when you add in your levels. So with our levels today, we have for the ES, let's go to the SPX here and the ES. We are right at our line in the sand or just over it. Right now, we're 57.04 in live pricing, and our line in the sand is 56.94. We are looking for rotational price action today between 57.10, so just above where we are right now, and 56.40 with our pivot at 56.72. If we get over our rotational high, we look for 57.52 and 57.77. And if we get under our rotational low, which isn't as likely today, 56.26. So we would look for 55.96 and 55.82. Other key levels to pay attention to on the ES today are going to be 57.42 3/4, 57.22 half, 56.61, 56.46 half, and 56.20 quarter. Now on to the NQ. Again, we have a lot more separation with our line in the sand, so that's been rising the last few days. It stays horizontal here on the chart for you. That's this pinkish line, but we are firmly over it, so that mitigates a lot of the downside risk. So today we will look for rotational price action from 20,279 to 19,945, and our pivot is 20,105. If we get over 279, then our targets are 20,546 and 446. And our lower targets are 19,778 and 19,678. But again, our line in the sand would be right there where those lower targets are. So unlikely we're going to reach there. That line in the sand is 19,797. Some other key levels for you today on the NASDAQ, 20,424, 20,241 3/4, 20,081 half, 20,021, and 19,878. And now on to crude. Again, we will watch this over the coming weeks, but anytime we come down to this 55 area, we are going to be long biased first. Once that breaks, then we would look for a move down to that 48 area that we mentioned a couple weeks ago. So we are looking today, rotational price action. So you can see we got, as long as we hold our bands here, hold our rotational zone, we color it so that you can see it a little easier. As long as we hold that rotational zone, um, we expect to go back and forth between there, and that's all we've done. We went there from Monday up, and then Tuesday down, and then yesterday we're heading back up. So 6103 to 5887 is that rotational zone. Over 6103, we look for 6211 and 6272. Under 5887, we look for 5779 and 5714, but really we'll look for anything sub 56, over 55 to start buying. And other key levels on oil today: 61.77, 60.84, and 59.92. And on to gold, we did make our all-time closing high. We have not gotten to that new all-time high yet on the futures, but we are still in a bullish move. Even if we come down to our lower end today, we will be over, still be a higher low currently in the cycle. So we are looking for rotational 3380, 0.7 to 3302. Our upper targets, if we get over 3380, would be 3444.3 and 3420.7. Our lower targets, breaking 3302 and getting kind of back towards yesterday's low, we would be looking for 3263 and 3239.6. And then some other key levels for you to pay attention to on gold: 3364.6, 3342.8, 3331.9, and 3310.2. So have a great weekend, guys. Again, is every trading day, just make sure you control your risk. If you can do that and your wins are bigger than your losses, you will be able to survive in this game. And that's the key, is surviving longer. It's not about making enough money in a day to retire, but making enough money over time to build, to be a consistently profitable trader and have a winning system so that you can basically print money every day and have a solid way to really trade for yourself. So have a great weekend, guys, and we will be back next week.